It's spring, and green is showing up everywhere. Is it a trader's dream or a signal of caution? In the past quarter, the S&P 500 index, the benchmark for U.S. equities, achieved 24 new all-time highs, climbing over 20% in the last 6 months without a visible drawdown in sight. This might spark a contrarian thought. Surely this can't be sustainable. It's entirely normal to think this. What goes up must come down, right? Yet, upon examining the data and history as precedent, well, we learned to stop worrying and love the rally, or at least to trust it and the fundamentals supporting it. I'm Philip Petursson, Chief Investment Strategist at IG Wealth Management. Join me each week as we discuss the trends dominating the investment landscape. It's the week of April 8th, so listen on as we navigate the living market. Aside from the post-COVID-driven meme stock mania of 2021, the last time we saw similar market activity was 11 years ago, in the first quarter of 2013. But let's go back even earlier to 2012. That year paralleled 2023 in many ways, with weakness in the spring and again in the late summer and early fall due to a post-Great Financial Crisis mid-cycle slowdown, but finished with a strong push in the fourth quarter. 2012 ended with strong returns overall. Then, 2013 started with a bang, with returns very similar to what we've seen this year. And that first quarter back then ended with an 11% gain, with over 40% of the days marking new highs, mirroring the latest trends. Was this a sign of a rally, or were equities due for a pullback? Well, first, let's acknowledge that volatility is a function of equity markets, and a drawdown of 5% is what we would call normal market activity. Something more meaningful would be a fall in equities by more than 10%, otherwise classified as a correction. Again, entirely normal, as corrections happen approximately every other year and for any and rather unpredictable reasons. So following the impressive 31% gain on the S&P 500 index in 2013, yes, there was a pullback of 5% in the first quarter of 2014. Entirely unpredictable and unremarkable, other than for being a completely normal market event. And yes, volatility may lie ahead, but not because equities have performed well in the last 2 quarters. What are the likely triggers? Well, the usual suspects remain disappointment with Federal Reserve actions, or rather the lack thereof. But other factors could also come into play. However, one thing is certain: volatility will pop up again, and it won't necessarily mean the end of the rally. In fact, market strength tends to have no more downside than other market environments, and yet does tend to enjoy more upside. Let me explain. Since 1927, when the S&P 500 index has gained more than 20% within a 6-month period, a drop of more than 10% has happened 23.9% of the time within the following 6 months. In every other market environment, a drop of more than 10% has happened 25.4% of the time. Really no significant difference between the two. So we have the same odds of a downside of greater than 10% as any other period. However, gains of more than 20% are followed by additional gains of 10% or more in the next 6 months, 52.1% of the time versus 39.4% of the time in all other periods. Therefore, same downside, better upside. In the last 100 years, the average 6-month drawdown has been minus 6%. The current 6-month weekly drawdown is less than 0.5%. Any dip in the market has barely had time to register before it's been bought up. The infamous Fed put may be gone, but it's been replaced by an extreme version of buy the dip. With so much money still on the sidelines, short-term yields expected to decrease later in the year, and recession fears behind us, as well as corporate profits looking better for the year ahead, this rally still has legs. Is it still a narrow market, though? In other words, has the recent rally been limited to the so-called Magnificent 7 stocks that include Amazon, Apple, Google, Facebook, Microsoft, Nvidia, and Tesla? No. In fact, the rally has been fairly broad-based, with participation across value and growth stocks, or as we like to put it, the forgotten 493 are returning the favor. Investors are bargain hunting in cyclicals, financials, and anywhere they can find attractive opportunities. In essence, don't believe the hype against the market solely based on the notion that it's rising too quickly. Such thinking has often led investors down the wrong path. Rather, take solace in the fact that the equity markets are answering our question posed in our 2024 outlook. What if it goes right? I'm Philip Petursson, and you've been listening to Living Market Podcast. If you've enjoyed this, please take a moment to rate it or share it with colleagues and friends. It will help other like-minded individuals find us. Thanks for listening.
The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purpose, and IG Wealth Management is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from expressed herein. Our views are subject to change based on market conditions. Commissions, fees, and expenses may be associated with mutual fund investments. Read the prospectus before investing. Mutual funds are not guaranteed, values change frequently, and past performance may not be repeated.